Welcome to another episode of What's at Stake, a Penta podcast. I'm your host, Bryan DeAngelis, a partner here at Penta. And today's episode is rather timely. We're going to continue to discuss the fallout from the collapse of Silicon Valley Bank and the ripple effect it has sent through the banking sector. We're going to get into a little bit of what's happening compared to what happened in the past, especially what both myself and my co-host, Ylan Mui, and our special guest to be announced in a second, all lived through in 2007 and 2008. We're also recording this on Monday, March 27th, my daughter's birthday, but more importantly, the day before we see some hearings both in the Banking and Financial Services Committee around this. We just got Michael Barr's testimony, so we're going to jump into all of that. But first, let me welcome Ylan Mui, a managing director at Penta and the host of our Macrocast podcast. And she and I are both thrilled to have our good friend, Aaron Klein, joining us as well. Aaron and Ylan, thanks for joining us.
Hey.
Pleasure to be back.
Yeah, you're a repeat guest. And for those who don't know Aaron, but I think especially over the last 2 weeks, he's been everywhere. Aaron is a senior fellow in economic studies at the Brookings Institution. He's focused on fintech, regulation, payments, macroeconomics. There's nothing Aaron doesn't cover in my mind. And I know Aaron from back in the day when he was chief economist for the Senate Banking Committee. We both worked for Chairman Chris Dodd at that time. And whenever I have a question on Dodd-Frank, I always go to Aaron. So he was kind of top of mind when all of this was going down and wanted to have you back here on the show, Aaron. So thank you again for joining us.
That's great. Let's dig in.
Let's jump right into it. Yeah. So obviously the collapse of SVB has had impacts all over the financial markets since it's happened. Talk to us a little bit. You've been everywhere, as I've said, and you know, I kept thinking about something you taught me very early on that, you know, it's actually a good thing to see banks fail every now and then. It's a sign of a healthy market, and banks should take on risk. And when I think is the case with SVB, when someone takes on too much risk, they probably should fail. But break down a little bit, you know, is that the case here? Obviously, SVB got a little probably out over its skis, but I think a lot of folks weren't minding the store either on the Federal Reserve side of things. So give us your take on kind of what happened here and what you're seeing.
Sure, Brian. Let's start at the top level, right? America has about 5,000, just a little bit under 5,000 banks. That's a wonderful thing. The diversity in the banking sector serves this country very well. We have 5,000 banks now because we used to have about 16,000. In the 1980s, we had 16,000 banks, not because that's what the economics or market said. It's because we had laws that precluded banks from banking in multiple states. Those laws were not rescinded until the mid-90s. So most people kind of think of big national banks or multi-state regional banks as something that's always been. In fact, it's a relatively new phenomenon driven by inherent economies of scale in the banking industry that were held back for over 150 years because of laws in America, actually over 200 years. So what does it mean to have 5,000 banks? Well, it means that you should have some differences. You should have some banks that try one thing and some banks that try another thing. I'll ask you guys a question. What was the first year in American history, going back to the founding of the Republic, where not a single bank failed?
I just looked this up yesterday. Was it 2005, 2006?
2005. 2005 was the first. So every year in American history till 2005, at least one bank had failed. All right. We had a pretty stable financial system most of the time. We had plenty of banking panics and crises. The banking nerds that listen to this will start yelling out the years, 1893, 1907, 1929, 30. But we always had at least one failure and the world moved on. 2005, something weird happened. Nobody failed. And then 2006, the same thing. Nobody failed. And Brian, you remember back at Senate Banking, the bank regulators came before Congress and said, we've won. We've done a fantastic job because no bank is failing on our watch. See, they misunderstood the goal of regulation. The goal of regulation isn't to preclude an individual entity from failing. That's like the granting of a perpetuity. You cannot fail. What kind of market is that? We have private banks, not public banks, right? So they missed it and they crowed about it. They said, this is great. We cannot fail. We've won. All these system, right, is so well regulated. Now we know 2007, 2008 showed that the financial system had never been in greater danger. We'd never had worse or more unstable banking system than the first 2 years in American history where not a single bank failed. Now, fast forward the tape. Do you know the next time that we go through 2 years without a single bank failing?
Now I want to say 21 and 22.
You got it. See, you came prepared for this one.
Well, that's the thing. I'm not smart. For the kids at home, this is just a good lesson to do your homework. I spent my Saturday night reading Aaron Klein op-eds, and you covered at least the first one in your 2018 op-ed, and lucky guess on that second one.
Well, listen, man, you must have gotten a lot. You must have gone to bed real early and gotten a good night's sleep Saturday night.
I did.
The point here is we not only are we deluding ourselves, but we have the wrong goal when the goal is zero bank failures. If no bank ever failed in the future, is that the mark of a healthy society? 4,700 something banks year after year keep making money. Nobody makes a mistake. And so the trick is, how can you develop a system where some banks take risks? Some banks do well, some banks do poorly. So a few banks fail without threatening the other banks, without undermining confidence throughout the system. That requires quality regulation, quality supervision, but also the regulators being willing to let folks fail and not hit the bailout panic button.
Aaron, can I jump in here and maybe
please
ask the corollary to that question, which is, if it's a good thing or possibly a good sign for the economy when banks fail, does that mean that you think that regulators should have let Silicon Valley Bank just die?
So a couple things on that, right? One is, I think regulators ought to have been flipping out in 2021 when not a single bank failed. Right now, what we're finding out is the Fed claiming, oh, we were on top of it because, by 2022, we had a matter requires attention, right? Which is a very low form of supervisory guidance. I'd be shocked if any of the banks that size don't at least have a few of these. Meanwhile, their problems and losses were already banked on the balance sheet. So part of the problem is they were drawing the wrong conclusion by seeing no one fail. They were thinking that the system was far more stable than it was. Should the actual case of SVB have been allowed to fail? I think there were a couple options, right? One was a purchase and assumption of the troubled assets of the bank by somebody else, as opposed to the guaranteeing of the uninsured deposits. That would have been preferable. In fact, we just saw this morning on Monday that we're taping that sale finally did go through. That would have been preferable to the blanket bailout that occurred. But secondarily, I would have let the institution go through its normal process. And that might have meant that Roku, one of the largest companies that were at the banks, a service I use on a daily basis, had about $450 million in the bank. They would have had access to about 65% of that immediately. And of the remaining amount, they would have gotten the majority of that, would have taken a little while. If you use today's announcement, I think total losses are estimated at $20 billion, right, which at the time of the bank's failure, it's often been reported they had $200 billion in deposits. Some people had already run, so the exact number may not be known. And whether the uninsured depositors, someone stood in front of them to take that loss, will be a very specific question about other elements of the whole bank holding company's balance sheet. But at a very rough first basis, that's 10%, $20 billion losses on $200 billion of accounts. We know that almost all of the accounts, 95 to 97%, were uninsured. They had very few banks. This wasn't a bank that dealt with people, right? This was a bank that dealt with businesses. The extent there were people, there were executives. So, some of these companies could have lost 10% of their bank balance sheet. That's a real issue. Would that have been better than the situation we find ourselves in? I think so. But we'll never know the counterfactual. What I can tell you is that the government, Federal Reserve, bailed out Bear Stearns in March of 2008. That didn't stop a financial crisis from happening. That we know. We know Bear got bailed out. Yep. We know the world still imploded. I don't think this is 2008 all over again. But the idea that bailouts stop crises is something we can all agree is false, right?
But can we also agree, and this is what I've struggled with, that, we seem to now have, despite all the rhetoric, and you and I were there, and our guy was saying it, that there would never be another bailout. I'm kind of the mind that there will always be bailouts. We are now, it's so politically sensitive that, even at 10%, and 2 weeks ago it was fear, uninformed fear that it was even more, but the FDIC, the Fed, the Treasury will always step up and cover that. And I just think we're sending a weird
terrifying.
message. Yeah.
Brian, that's terrifying because why don't we just say the current holders of wealth have a perpetual right to unlimited wealth in the future?
That's basically what we're saying.
Right now, you want to invest in money market mutual funds, put all your money in government accounts. The government you can have your money forever. I mean, is that a society where banks will never fail? Rich investors will always be rich if there's an unforeseen accident. I mean, I think you're right to draw this into other bailouts, right? The bailout of money market mutual funds, something expressly not guaranteed by the government, that we saw the Bush administration do in 2008. We saw the Trump administration do in 2020 due to COVID. Now we see a bunch of money moving from banks into money market mutual funds, right? Why? Well, presumably they think they're just as guaranteed and they have a higher yield. And so bailouts beget bailouts. And it's a dangerous precedent. What I have to say back to that, though, Brian, is somehow we didn't have that for generations.
Right.
Generations in America, people lost money. And is it an attitude issue? Is it a generational issue? I mean, we're all parents on this podcast, right? And we all love our kids, and nobody wants to see their kid get hurt. But, my kids play sports. Your kids play sports?
Yeah, absolutely.
My kids play sports. They get hurt.
Yeah.
They get hurt when they play sports.
Yeah. Do they lose sometimes too?
Too much.
More often than not. Yeah. Especially when I coach them, but that's another issue. Yeah.
Right. But we're right. I actually don't mind. Like when my kids lose, it's a chance for them to learn that losing sucks, but it happens. Doesn't mean you're a bad person. Doesn't mean you didn't play hard. Right.
No, it's to your earlier point. It's a sign of a healthy market when we have risks and rewards and losses. And, that's not to say, look, I'm only watching from the sidelines and I, understand the importance of systemic risk and stepping in and being responsive. But, it's leaving a lot of questions of where do we go from here? Are we missing the bigger point, which I do want to jump in a minute, which is where regulators a little bit sleep at the wheel here. And even some of the other debates that came out of, you've got a lot of folks on the Democratic side of Congress saying, well, this is all the 2018 reforms fault. And I'm not sure that's true either. I think this is much more focused on it. Yes, the thresholds bring different levels of scrutiny. And yes, SVB grew very quickly, but they grew presumably that quickly under the watchful eye of the Fed. So what happened here? And that's not really a question for anyone, but I'll toss it up if anyone else has thoughts there.
Yeah. So look, there are a bunch of different things here, right? Let me try to tackle one of them, which is the question about the bank rollback, right? So in bank regulation, there are two terms, regulation and supervision, and they're often used interchangeably, but they're very different concepts. Regulation are the rules. Supervision is the enforcement, right? Right. I know that you and I were both at points in our lives big NFL fans, and I think about this like I think about the rule of what is a catch in football. There's a rule.
Yep.
And
I can't tell you what it is, but
it's confusing. That sounds like a bank regulation, right? It's 10,000 pages. It tries to cover every scenario. And then all of a sudden there's something, right? So sometimes you watch a play and you're like, is it a catch? Is it not? I don't really know. And the rule isn't clear, right? Or, sometimes the rule is very clear and the referee just botches it, right? That's supervision. Supervision is enforcing the rule. So you can debate the rule book. You can change the rule book. You can legislate the rule book. There are lots of things Congress can do about the rules, regulators can do about the rules. That's regulation. Then there's supervision, enforcing the rules. So let's just level set with facts now that we have two different concepts in our mind about regulation and supervision. Dodd-Frank required that enhanced prudential standards, tougher regulation, tougher rules be applied to banks over $50 billion. In S-2155 in 2019, when Congress rolled back this provision, they changed the number from 50 and they said banks under 100 don't have to deal with this enhanced prudential regulation. Right. Tougher rules. Banks between 100 and 250 go from mandatory to discretionary at the Federal Reserve's discretion. If you think this bank is systemically risky, apply the tougher rules. If you don't think they're systemically risky, don't. And then over 250, you have to. Those were the changes. Those are just facts.
Yep.
Now, here are a couple more facts. One, the Federal Reserve chose not to enforce those tougher rules on Silicon Valley Bank as it grew in size all the way up to 200. By making that choice, the Fed was deciding implicitly, but also somewhat explicitly, that its failure was not systemically risky. We know two things. One, it failed. Two, the Federal Reserve Board of Governors in a unanimous vote voted to bail out and establish facilities because of its fear of systemic risk. So by the Fed's own admonishment, it botched its discretion on Silicon Valley Bank when it was between 100 and 250 in its failure to apply these tougher rules. Mistake of judgment and a mistake of Congress to grant discretion to the Fed as opposed to mandatory, something the Fed preferred. If you go back and listen to Fed Chairman Powell, he said, don't worry about this bill because we maintain all the authorities we had prior to, and we'll use them when we need to, and they didn't, right? Now, that's all fact. These things I think are so self-evident that I would say they're fact, not opinion, but it's very difficult, to say so otherwise. But we're talking about enhanced prudential standards, tougher rules. That's what this whole tougher regulation, it's sometimes called systemically important financial institutions or bank SIFIs. But for those of us in the know, we know that that term SIFI actually as a legal construct only applies to non-banks like AIG, right? The actual term in Dodd-Frank and the actual law is enhanced prudential standards to banks. The term for systemically important financial institutions are only reserved for non-banks. Popular nomenclature gets that wrong, but think about enhanced prudential standards like an honors test or an AP test, tougher test for banks. What the failures at Silicon Valley Bank were simple failures. They were failures that should have been caught by the basic test, the remedial test, the entry-level test, not the honors test, right? And I can go through those classic 4 red flags in a moment. So when people say, though, well, the problem was this rollback. If we hadn't done the rollback, we would have caught them because these tougher standards would have caught it. I think to myself, well, okay, maybe they would have failed the tougher test, but they should have failed the basic test that was being applied anyways. So the real failure here is a failure of supervision. That is a failure of the Federal Reserve to catch basic structural mistakes this bank did. Had the honors test been in place, maybe it would have caught it, maybe not. There's a lot of very detailed things. We can go through what that honors test was, which years and how the bank would have applied it. But if you take a step back and get out of the weeds, if the Fed can't catch something like this with a basic test, then what the heck is the point of the honors test? Because this is not complicated stuff here.
It's a fair point. And Ylan, I want to bring you into this conversation. We just got our hands on Michael Barr's testimony, and I don't mean to be overly critical of Barr, but he seems to be pointing fingers in a lot of different directions, kind of
all away from the Fed.
To this point, right? All away from the Fed. But I tend to agree with Aaron here that, there was a missed reading or whatever you want to call it, but the supervision kind of failed on the Fed side. Tell us a little bit. You read Barr's testimony too. What is he going to say tomorrow and when? I think it's tomorrow and Wednesday. And what's your take on it?
Yeah, I think he might be over-indexing here, anticipating that he's going to face some really tough questioning, I think, from both Republicans and Democrats during his testimony. The Fed has said that it is beginning or already conducting an internal investigation to find out what happened, what it missed. It says that that's going to be out to the public by May the 1st. And he said that the Fed's review would be, quote, unflinching. It's going to take a really hard look at what it's been doing. He said that the Fed will be fully accountable for its supervisory or regulatory failings. They want to fully address what went wrong. But then, as you point out, through the rest of his testimony, he goes on to say all the things that Silicon Valley Bank did wrong, all the times that the Fed raised questions about the bank's behavior and the bank's balance sheet, but didn't actually do anything about it. So he details a number of times, specifically pointing to as recently as February of this year, when the Federal Reserve staff gave a report to the board saying, here's what the outlook for banks is in a rising rate environment. This is the interest rate risk that we see. They've particularly called out Silicon Valley Bank during that report. But at the time, the staffers assured the Fed that they were actively engaged with the bank's management in order to start addressing some of these risks. Now we know they couldn't have been that active because the bank failed about a month later after that report was given.
Right.
So I thought it was really interesting that he had this line in his testimony where he said, it is not the job of supervisors to fix the issues identified. It is the job of the bank's senior management and board of directors to fix its problems. So to me, what he's saying there is, we tried to tell you. We tried to send you a memo. If you didn't read your email or you didn't open the memo or you didn't implement the ideas that we gave you, that's not our fault, that's yours. But to Aaron's point, I think that there are degrees of urgency, right, within the Fed's supervisory process. They could have elevated the urgency of these decisions. And I think that there might be some just bureaucratic inertia involved here. Maybe they thought they had more time and they obviously did not. So I think that Barr's goal here is to, number one, assure the public that the banking system is sound and resilient, of course, but also essentially to defend the Fed at a time when he knows he's going to get called out on this when he's before Congress, and he defends the Fed by placing the blame on other people.
So let me jump in because there's a lot to respond to that, which I think is fascinating. Right, one is, he talks about in his testimony about how they finally got rid of the bank's management and fired them all. He doesn't mention at all that the bank CEO was on the board of the San Francisco Federal Reserve. Right, so right. The Federal Reserve Board of Governors in Washington, which is part of the United States government, which writes the rules, outsources the enforcement of those rules to the 12 regional Federal Reserve banks, which are these weird hybrid entities owned by their local member banks with a very convoluted structure of a board of directors who appoints the president subject to approval of the board in Washington. And in San Francisco, the president of Silicon Valley Bank was a member of the San Francisco Bank Board. So if you think that this bank is mismanaged and their senior management isn't paying attention to your memos, don't you think that's quite a different symbol you're sending to the world that their CEO is on the board of directors of the institution it's regulating? One. Two, there's a statement that the Fed is going to be fully transparent. And central banks understand the value of credibility when it comes to monetary policy, right? As somebody who studied monetary policy theory quite a bit and was very engaged in overseeing the Federal Reserve in my role in Congress, there's this core belief that for the Fed to be credible in fighting inflation, credible in interest rates, its interest rates have to be credible to the market. When it comes to overseeing the 12 regional banks, the Fed's process has strained credibility to laughability. Let me give you some facts to support that statement. Two Federal Reserve Bank presidents, the president of Boston and the president of Dallas, made a set of trades out of their own personal accounts in March and February of 2020 during the COVID hysteria. These trades were approved by the Fed as being ethical at the time they were made, and at a year lag when disclosed to the public, created such an outcry that both board bank presidents resigned. They weren't fired, a theme we'll get back to in a second, but they resigned under the face of scrutiny of these trades, which the public certainly didn't view as ethical. The Fed promised a review of this and told us not to worry that none of the trades were made during periods of blackout periods right before the Fed made monetary policy choices. Okay, so if they weren't made during blackout periods, when were they made? The Fed has refused to tell the dates of the trade. Jay Powell has asked repeatedly. In fact, in his very last press conference, Craig Torres from Bloomberg asked this question, and you could almost hear Powell exasperated saying, you've been hounding me on this. I don't know the dates of the trade. We don't know. Really? Is there anything in the world more knowable than the date somebody sold or bought a financial asset? Every stock trade or bond trade has a date. You're the central bank. You're a $5 billion institution regulating everybody, and you don't know the date of the trade. The only way you can honestly say you don't know is you didn't ask. Or you asked and you said, well, I don't care if you, please don't tell me the answer, right? There's sometimes you ask a question and you don't want to know the answer. If you wanted to know the answer to the date of the trade, it's very well known.
And this doesn't seem like it bodes well for the Fed's review of what happened at Silicon Valley Bank. Clearly, there's been a lot of focus on Mary Daly, the San Francisco Fed president, and what her role may or may not have been in this mess. Do you think that she ends up stepping down, resigning, getting fired? How much is she implicated here?
So it's really hard to know. Another example, the Richmond Federal Reserve was the subject of intense scrutiny over a leak about a controversial FOMC document that went out to the public through somebody who's kind of said they were the press, but they were really an investment advisor. The Fed promised a deep investigation into this leak, which it uncovered nothing. In the process, it reappointed the sitting president of the Richmond Fed. These presidents are appointed, and they're subject to, I think, every 5 years a review. In the history of the Fed, nobody has ever not been given an automatic reappointment. But legally, the board has this 5 year to reappoint. In the midst of the investigation, they reappointed the Richmond Fed president. Finally, the FBI got involved after the Fed had swept this so far under the rug, the cat was choking. And the FBI in 3 seconds found that this guy had leaked. And the guy resigned and basically cut a deal with the FBI. So the FBI could figure out that the president of the Richmond Fed was the leaker real fast, and the Fed could never magically find this same fact out. Again, reappointing a guy who was later under FBI investigation. So you ask the question kind of like, do I think, one, I don't know about anybody specifically. Two, I have a lot of sympathy because it's not President Daly's fault that bankers sit on her board. That's true of all the Federal Reserve regional banks. That's something Congress set up, and I think something Congress ought to change. But I do think that there's kind of a question about who's going to be held culpable. One thing I would point out for Fed watchers listening is that the Federal Reserve staff is incredibly powerful. The Board of Governors staff is incredibly powerful. And when I served on the banking committee, when I worked at Treasury, I helped interview and vet almost every single Federal Reserve governor from 2001 until 2012. And one way to divide those governors who served over 12 years was, did the governor make a difference and overrule the staff at any point? And a lot of them didn't. A lot of them, I would say, just kind of went along with where the staff was moving things. This internal review process gives Barr tremendous power to shuffle the deck of career Fed staffers in the bank soup and reg policy in both Washington and in many offices across the country. And I think he will aggressively use that potential power to reshuffle that deck to get a group of folks in that are much more aligned with his view. And I think one of the outcomes of this Federal Reserve process will be the reshuffling of the internal staff along the lines of folks that are more aligned with Barr, which will have a much more long-lasting viewpoint than a lot of potential debates about the rules.
That's interesting. I mean, obviously some pretty talented staff. I don't know many of them personally, but that's an interesting take on this that I haven't thought about yet. I want to dive in deeper, but we're also running out of time. And I have to ask, we've talked a lot about the report and what the Fed's done. I want to get your take on what this means for the Fed going forward. I don't want to exaggerate that, there's going to be a crisis of confidence or anything like that. But obviously we are in a very tough economic moment where Powell is trying to, soft land the plane on the economy. And this is one more wrench in the gears. This is one more distraction. And while somewhat separate, you could argue, at least the investigation part of it, not the actual SVB failing, you are going to have policymakers kind of breathing down his neck even more. So really to both of you, what do you see kind of coming out of the hearings this week going forward, and how is this going to mess with Powell's thinking?
Yeah, look, so there's a couple different elements here. Macroeconomically, the Fed is achieving through bank regulation what it was struggling to do through monetary policy, which is slow the economy, right? So the Fed have been trying to slow the economy by raising interest rates. Now it's going to slow the economy by contracting credit, which is a much worse way to slow the economy, but that's a separate story. Credit contractions like monetary policy take time to work through, right? The great credit crunch in 2008 was August, September, October, right? But the recession really picks up down the road a little bit.
Do that, yeah.
And so similarly, when you raise interest rates, markets move instantaneously, even front running the Fed. But the real maximum impact of a rate hike in the real economy is usually about 12 months with about a 6-month standard deviation. So between 6 and 18, you capture, I think, most of the impact. So market people often get wrong the lag time of monetary policy, both of these functions, because they're following markets, not following jobs and GDP and what we call the real economy. Right. And so this is going to slow the economy. And to the extent that this is being added on top of the interest rate movements. To the other side, because it's a credit crunch, not a traditional monetary policy, it's going to slow the economy in a different way. Interest rates have gone down, right? Ironically, the very assets that Silicon Valley Bank held that were underwater because they bet wrong on interest rates and unhedged were worth more after their failure because their failure drove down interest rates in the panic. So that's become complicated. The political side, Brian, I really scratch my head. The Fed has made so many mistakes over so long as it relates to regulation. And every time they come out more powerful. Our boss, Senator Dodd.
Yeah, I know where you're going here. Yeah.
Proposed moving regulation of banks like Silicon Valley Bank out of the Federal Reserve. The original, his version of what became Dodd-Frank proposed moving that out of the Federal Reserve into essentially the OCC, the national bank regulator. That came to a vote in the Senate. He lost that vote 90-9. 90 senators voted to keep the regulation of SVB at places like the Fed. That amendment was led by Senators Klobuchar and Hutchinson of Minnesota and Texas, two homes of two powerful Federal Reserve regional banks, one I like a lot more than the other. We'll get aside from that injection of personal preference to the fact that every single Republican and almost all the Democrats voted to keep bank regulation like this at the Fed. So, the history of this situation is the Fed becomes political enemy number one and pays a positive price in the sense that they gain more power at the end of the day. This has been true under Democrats and Republicans. And so if I had to make a prediction, I would say somehow Congress beats up on the Fed and then grants them more authority.
Interesting.
I have a political prediction.
Ylan, you want to follow that?
Yeah. I mean, I have a slightly different political prediction, but I'll tie it back to monetary policy at the end, which is I don't think there's going to be any major change from Washington out of this scenario. But what I do think this does is it gives Republicans a chance to crystallize and hone an attack they've been sort of working on for maybe the past year, 2 years now, around the challenges that the financial services industry and the Fed in particular have around climate change, around ESG, around issues like DEI. And they are really starting to use that as a cudgel in this situation and arguing that the Fed, both in San Francisco and sort of writ large, were so distracted by their efforts to incorporate climate change into their monetary policy and bank supervision regime that they didn't pay attention to the real fundamental underlying problems that were going on banks right under their nose. Now, that may or may not be an argument that you agree with, but it has become a potent and powerful line of attack from Republicans. And so I think that they've been trying to find ways to bring this home to the public for a long time. And I think that this banking crisis is a chance for them to really underscore and highlight those arguments. How does this relate to monetary policy? How is this not just political noise? Well, right now, the Biden administration is trying to fill a seat at the Fed's Board of Governors that's been vacated by Lael Brainerd, who is now at the National Economic Council. That line of questioning and that line of attack is going to be front and center for whoever Biden ends up nominating for that position, the person who will be directly responsible for making monetary policy decisions. At one point, Mary Daly, president of San Francisco Fed. Her name had been bandied about as a potential replacement. We now know that's going to be dead on arrival, at least for her nomination. But who else could Biden possibly pick? I think he's going to be a lot more constrained than he would have been outside of the crisis that we've seen over the past few weeks.
So I just can't let this point go without just pointing out the ludicrousy of the argument. I'm not saying you're making the argument. I understand you're saying it, right? Frank Luntz has a great polling comment about woke, right? Woke polls really bad. And you have a bunch of members who see that there's a really good polling argument. So whatever's on the front page of the newspaper, say it's woke's fault. That's as much logical credence as the idea gets that a bunch of bank regulators and senior management, Silicon Valley Bank, and everybody else was missing these clear mistakes because of wokeism, whatever that means. I believe I don't
think they can define what wokeism is. However,
no, that's right. So right. That comes from a fellow Montgomery County, Maryland, usually the home of the best thinkers in the world, but not always, person, right, who struggled with that in that kind of social media point of view. And so, the fact that this occurred in San Francisco, which is often used as a kind of catch-all for these types of things, or that there were diversity goals in this situation is kind of laughable. Anybody who knows Silicon Valley knows that venture capital does a really bad job of investing in minority entrepreneurs and women entrepreneurs. I think there's some crazy, horrible statistics about the amount of venture capital that goes to African-American women and other people. I'm a dedicated watcher of Shark Tank. And one of the things you see on Shark Tank all the time are women and minorities and people who struggle to get into this VC club. Meanwhile, Sam Bankman-Fried can be playing video games and have venture capitalists throwing billions of dollars at him, right? So they'll make the argument and it may resonate politically, but substantively, it is, one of the worst arguments I've heard in a long time. I've been around a lot of banking conversations. I've agreed with conservatives more times than I'm comfortable acknowledging often. But that one's complete junk.
I think you're probably absolutely right. I think we're still going to hear a lot of it the next 2 days. And Ylan, I think, this will probably be topic number one on the Macrocast on Friday, just given I think Barr will get a ton of it tomorrow and Wednesday. But we could we could keep going. Unfortunately, we're out of time. But Aaron, I was hoping to get into a little debate with you, which it's probably better that the clock ran out because I'm sure I'd lose. But maybe in 30 seconds, tell us, I've read a lot and I tend to believe that there's some credence to the fact that this was the first social media bank run. And I'm nervous, to say the least, that our regulators are generally prepared for how fast information moves, how misinformation moves quickly. Tell me 30 seconds So
blaming, look, Barr mentioned social media twice in his testimony. That's one of the examples.
Involving risks, I think, was
pointing the finger at everyone else. Silicon Valley Bank was a bank of large corporations. This, to the extent there was a run by corporate treasurers, this was a run on an email listserv run by venture capitalists, not on a Twitter thing. Silicon Valley Bank had 16 branches. Most banks of its size has 1,000. It had 95 to 97% of its accounts were over $250,000. You think corporate treasurers are basing the movements of their banks on tweets from Joe in Cincinnati? No, these came from emails from venture capitalists, often many of whom were or were not part of Silicon Valley Bank's venture capital arm. It was distressing to me that Barr at no point mentions the affiliated venture capital firm and its relationship with the companies that were banking with Silicon Valley Bank. Let's be clear. Silicon Valley Bank was a bank to giant tech firms. Right. These aren't basing their corporate treasury decisions on the basis of random tweets, right? What drove this thing were a set of emails, often coming out of Seattle VC arms. Now, maybe you're going to turn back to me and say, it wasn't on email, it was on Signal or WhatsApp or, some other social media.
Well, I know, but same difference there.
That is a textbook 101 of saying, it's not us. Who knew there was a thing called Twitter and that. You want to talk about a retail bank run? Those things happen. That happened at IndyMac. I'm not saying it hasn't happened, or I'm not saying some of the systemic impacts of the run on in other places, but the idea that Silicon Valley Bank itself was affected by tweets. The Wall Street Journal ran a front page story about the problems in the bank in November in 2021, which, by the way, seems to be before the Fed even sent any matters requiring investigation attention to the bank. So the Wall Street Journal this was front page of the news in November. Come on, man. Twitter, please.
I was hoping the clock would save me, but alas, I think you won that round, and I'll come back to you another time about whether the regulators are actually prepared for the new world or not. But Aaron, always entertaining. More importantly, always really insightful. And you've been, as I said in the intro, everywhere the past 2 weeks, educating folks on this. So I really appreciate you taking a little time here to educate our audience and join Ylan and myself. So thank you for coming on, and we'll have you on again soon, I promise.
Sounds great. Thank you, guys. It was a wonderful pleasure, Ylan, Bryan. It was great. Thank you.
Awesome.
Thanks.
And for our listeners, hope you enjoyed the show. For more episodes of What's at Stake, you can subscribe to the Penta podcast channel wherever you get your podcasts. You can find us on Twitter at PentaGRP or on our website, pentagroup.co. Bryan DeAngelis, Ylan Mui, thank you for joining us once again this week.